What if I told you there are ETFs that pay you every single week? Most people think dividends come quarterly, maybe monthly if you're lucky, but there's actually a small group of ETFs that put money in your pocket every 7 days. I've spent weeks analyzing these weekly dividend ETFs, cross-referenced multiple sources, and verified every single number with official fund documents. Today, I'm going to show you the 5 safest weekly dividend ETFs that can actually put money in your pocket every single week. These range from ultra-conservative government securities to high-yield option strategies, so there's something for every risk tolerance. So grab your coffee, hit that like button if you want to learn about weekly income investing, and let's dive into these weekly money machines. ETF 1 Week, Roundhill Weekly T-Bill ETF. Let's start with the ultra-safe option, the Roundhill Weekly T-Bill ETF, ticker symbol WEEK. Think of WEEK as your financial safety blanket. This fund is like having a direct line to the U.S. Treasury Department's money vault. The market price sits at $100.02 with practically no volatility, and it has $105 million in assets under management. The expense ratio is just 0.19%, which is incredibly low, and the current forward indicated annualized dividend yield is 1.72%. While that might seem low compared to other options, remember this is backed by the full faith and credit of the U.S. government. So, how does WEEK actually work? Picture this. Imagine you're running a ladder business, but instead of physical ladders, you're building ladders out of Treasury bills. WEEK invests exclusively in U.S. Treasury bills that mature in 0 to 3 months. They create what's called a rolling ladder. As one T-bill matures this week, they reinvest in a new one that matures in a few weeks. This creates a consistent weekly cash flow that gets distributed to you as dividends. The beauty here is safety. These are backed by the full faith and credit of the U.S. government. If the U.S. Treasury defaults, we've got bigger problems than our ETF portfolio. Who should consider WEEK? If you're ultra-conservative, maybe you're retired and you absolutely cannot afford to lose money, or you're parking cash temporarily, WEEK is your friend. You're essentially getting paid to hold the safest investment on the planet while receiving weekly income, instead of waiting months for your money to work for you. ETF 2, MMKT, Texas Capital Government Money Market ETF. Now let's step up the income game with ETF number 2, the Texas Capital Government Money Market ETF, ticker MMKT. This is where things get interesting. If WEEK is your safety blanket, MMKT is your safety blanket with a built-in heater. The market price is $100.20. It has $57.6 million in assets under management, and the expense ratio is 0.20%. But here's the exciting part. The 30-day SEC yield is 4.89%. That's more than 6 times higher than WEEK while still maintaining that government security backing. Here's how Double MKT works its magic. This fund operates like a traditional money market fund, but as an ETF, investing 99.5% in government securities, repurchase agreements, and cash. They follow SEC Rule 2A7 compliance, which means they maintain a weighted average maturity under 60 days. Think of it as WEEK's more aggressive cousin, still incredibly safe, but willing to stretch out those maturities just a bit to capture higher yields. The fund essentially acts like a government-backed savings account that pays you weekly instead of monthly. You're still dealing with government securities, so the safety profile remains extremely high, but you're getting compensated much better for that safety. Who's the perfect investor for MMKT? Conservative investors who want money market returns with weekly liquidity and higher yield than traditional cash alternatives. If you're someone who keeps large amounts of cash sitting in low-yield savings accounts, MMKT could be your upgrade path. You maintain that conservative profile while dramatically improving your weekly income stream. ETF 3, BRKW, Roundhill BRKB Weekly Pay ETF. Here's where we get into something really interesting. The Roundhill BRKB Weekly Pay ETF, ticker BRKW. The market price is $45.85. The fund has $4.2 million in assets under management, an expense ratio of 0.99%, and a distribution rate of 3.02%. But what makes BRKW fascinating is that it's essentially Warren Buffett's Berkshire Hathaway with weekly paychecks. The fund uses total return swaps to achieve 120.60% exposure to Berkshire Hathaway Class B shares, while holding Treasury bills for leverage management. Think of it this way. If you invest $1,000, you're getting $1,206 worth of Berkshire Hathaway exposure. The fund derives income from Berkshire Hathaway's performance and covered call premiums, then distributes that income to you weekly instead of Berkshire's traditional approach of never paying dividends. This is perfect for investors who love Warren Buffett's investment philosophy but want enhanced returns and regular income. You're essentially getting the world's most famous investor managing your money, but with a twist of modest leverage and weekly income distribution. The 1.2x leverage level is conservative compared to many leveraged products, and Berkshire Hathaway is known for its quality and stability. However, keep in mind that with only $4.2 million in assets, this is a relatively small fund, which can mean higher volatility and potential liquidity concerns. ETF 4. SDTY YieldMax S&P 500 DTE Covered Call Strategy ETF. Now we're getting into the high-yield territory with the YieldMax S&P 500 DTE Covered Call Strategy ETF, ticker SDTY. This fund has a market price of $44.84. $13,450,000 in assets under management, an expense ratio of 0.99%, and here's where your attention will peak. A distribution rate of 23.69%. Yes, you heard that right. Nearly 24% annual yield paid out weekly. Let me explain what 0DTE means and how this strategy works. SDTY uses a strategy called 0 days to expiration options. Every single trading day, this fund sells call options on the S&P 500 that expire that exact same day. They collect the premium from selling these options and distribute that income to you weekly. It's like running a daily options operation where you're collecting small premiums from option buyers who are making very short-term bets on market direction. Here's what you need to understand about this strategy. In their most recent distribution, 51.60% was return of capital and 48.40% was actual income. This means that over half of your dividend is actually your own money being returned to you. The fund is designed to generate high current income, but some of that income comes from returning your original investment over time. While that 23.69% yield looks attractive, you need to understand that a significant portion represents capital return rather than pure investment gains. ETF 5, GLDY, Defiance Gold, Enhanced Options, Income ETF. Finally, we have the highest yielding option, the Defiance Gold Enhanced Options Income ETF, ticker GLDY. This fund has a market price of $17.37, $4,780,000 in assets under management, an expense ratio of 0.99%, and an impressive distribution rate of 41.74%. This is the highest yielding weekly dividend ETF in our list. Here's how GLDY creates this substantial income stream. The fund sells put options on SPDR Gold Trust, which is the most popular gold ETF, while holding cash and treasury bills as collateral. When you sell a put option, you're essentially saying, I'll buy this asset at a specific price if it drops to that level, and you pay me a premium for that promise. If gold stays above the strike price, GLDY keeps the premium. If gold drops and they get assigned, they end up owning gold, which provides inflation protection. This strategy allows them to generate income while potentially gaining exposure to gold. However, here's the important detail about GLDY's distributions. 93.40% of the distributions are return of capital. This means that the vast majority of your dividend is your own money being returned to you rather than investment gains. The fund is designed to provide high current income, but most of that income comes from systematically returning your original investment. Think of it as a structured way to receive your own money back over time while potentially benefiting from the options premiums and any gold price appreciation. Both SDTY and GLDY represent high-income strategies that prioritize current distributions over long-term capital appreciation. They're designed for investors who want maximum current income and understand that much of that income comes from the systematic return of their original investment rather than pure investment gains. So there you have it, the 5 safest weekly dividend ETFs, each with their own unique approach to generating weekly income. We've covered everything from ultra-safe Treasury bill strategies with weak to complex options income strategies with GLDY. The key is matching your risk tolerance and income needs with the right strategy. If you want maximum safety, stick with weak and MMKT. If you want higher income and understand the mechanics, BRKW, SDTY, and GLDY offer more aggressive approaches. Remember, higher yields usually come with higher complexity and different risk profiles. The beauty of weekly dividends is that you get to see your investments working for you every single week. Thanks for watching. Hit that subscribe button for more income investing strategies. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.